G'day everyone, welcome to this webinar for the 1st of March, and it's about profiting in a market of opportunity. And we've certainly got markets that are just diving around all over the place at the moment. And it's certainly presenting pitfalls, but it's also presenting a terrific number of opportunities as well. So that's really what the focus of tonight's webinar is about. Just a little bit of housekeeping before I start. I just need to draw your attention to the details at the bottom of this first slide with respect to my license. I'm a representative of AG Capital Markets, and the information contained in this webinar is of a general nature only. Now, you'll notice that you've got a chat box facility, and I really invite your questions during the webinar, because what I'm going to do is stop periodically and answer those questions. So if you can, as they occur to you, if you can pop them in there, and we'll have a couple of very short breaks during the presentation, which I expect is probably going to take the best part of an hour. I've got an enormous amount of content to get across to you, and I hope you get a lot out of it. Justin may come in from time to time. He's handling the administration of the webinar, and sometimes I get on a bit of a roll. I get a bit engrossed in what I'm doing, and I may just kind of forget that there's questions there. So if Justin kind of bounces in and interrupts me, then that's him just doing his job. Alrighty, let's get on with it. The agenda for tonight, I want to look at what is driving markets over recent times, because it's safe to say since the middle of 2015 there really has been a substantial change in the nature of markets, not only in the factors that are driving them, but also in the way that they're behaving technically. So is it a new set of trends? Yes, I think there certainly are a new set of trends in both directions, that's for sure. And it represents both opportunity and danger. And I guess if you've been in the market over the last 6 months, then you're probably somewhat aware of the pitfalls that are out there. I want to take a look at what it means for investing. More importantly, how to go about lowering your risk, but still be able to target some above average returns. And that's really the key, capital protection first, and then, putting yourself in a position to get some good returns through that. And there's definitely some techniques that you can use that sway that equation much, much more in your favor, where you can lower your risk but still get good returns. So you don't have to be a victim of this incredible market volatility. I want to have a look at how to profit when the market falls, where some of the best opportunities are right now. Really importantly, I've pulled out a couple of the really key things that I've learned over the last 3 decades of messing about in the markets, and particularly the last decade and a half, when this has really been a full-time occupation and full-time business for me. And then I just want to finish off with the services that I offer for those that are interested. There's membership options for if you want to do it yourself for both Australian and US stocks. If you don't want to do it yourself, then I've also got a fairly unique fund that deals in Australian and US stocks for both retail and also sophisticated investors. So let's start off. Is this what we have at the moment? Have we got a huge big bear chasing us down the road? But look, I think the answer is quite clearly yes, because the technical definition of a bear market is that the market is 20% or more from its peak price, and almost all indices around the world are in that position. And in America, the S&P index is not quite there, but it's not far away. Wouldn't take much to get it there. And a very high proportion of American stocks are are well and truly in bear markets. Some of them are 60, 70, 80% off their highs. So there's no question that, we're in a bear market. The only real question is how deep will it go and how long will it take? That's really the issue. So I'll try and shed a little bit of insight onto that tonight. So stripping it back to the basics, what is investing? That might seem like a bit of a redundant question, but I find talking to lots and lots of different investors and traders as I get the opportunity to do, that most people get too involved in the day-to-day toing and froing of the market, and you get your nose that tightly pressed up against the glass that you actually forget some of the bigger picture things about what we're trying to do. So stripping it back to the bare basics, your goal is to be mostly invested when the indicators tell you that the risk in the market is low, and less invested when the risk is high. Now that might seem extremely simple, but I can assure you that most people get too close to the action and they actually miss that, that key perspective. And the third part of it is the idea is that we want to get the most we can out of the really big moves, and we get the really big moves mostly right. And if you can do that, you're going to be a very successful investor. But it gets, it's simple to say, but it's not that easy necessarily to do, because you do get a bit too involved. But at the moment, as an example, there's really nothing much on the planet that's trending, except obviously some individual stocks that are in a significant bear market. We've got a lot of churning up and down in the short to medium term. And about the only asset class that I can see that is really close to or perhaps has started trending, and that's gold stocks, which are looking more and more promising by the day. So if that is going to be a big move in gold stocks, and it's not absolutely confirmed that it will be, but if it is, its history would show that it's going to go for multiple years, typically between 2 and 5 years for a gold bull market. And it goes a long way, and the percentage gains are very, very substantial. And I don't see why, if this is going to be a new bull market in gold stocks, and there's a very strong rationale for why that's the case, both fundamentally and technically, then potentially there are very substantial rewards on offer. So just bear that perspective in mind. So let's have a look at what is driving markets at the moment. At the biggest picture level, these are the things that I think are driving markets. Since 2009, risk has been drastically mispriced. People have been accepting high risk of default, particularly in what's called the junk bond market, for a lousy return, half to a third of what they should be getting given the risks involved. Now that's all tied up with the fact that low interest rates and all the other actions of the central banks that have just forced investors to chase returns, and they've forgotten about risk. And ultimately, all things that get out of kilter correct back towards a long-term normal or a long-term mean, and that's happening now. We're seeing that in the junk bond market, with yields on junk bonds had got down to a crazy low yield of around 5 or 6%, and now the junk bond market has moved back, and the average yield is now about 10%. So it is correcting back towards normal, but it's nowhere near there yet. However, what's kind of mucking this up is that central banks are fighting this all the way. They're now pushing into negative interest rates. We've got negative interest rates in about a quarter of the developed economies of the world, throughout Europe, Japan, several Scandinavian countries. And even the Americans are kind of mouthing the possibility that they might eventually go to negative interest rates there. So central banks are fighting it all the way, but in doing so, increasingly I can see the commentary that central banks are losing credibility, and that's a real concern. So they've been embarking on the greatest financial experiment that the world's ever seen, and clearly it is not working. Because otherwise, why would they now, after 6 years, be going negative interest rates? The ECB coming out and saying, we're going to fire as an even bigger bazooka than we've fired before, and we're just going to do it for as long as we need to. If it was working, they wouldn't need all this. So clearly this experiment is not working, and you've got to wonder how much ammunition is left. There is also a currency war in progress that started up again, and look, it's just all going to end rather badly. I think it's a race to the bottom, and I don't know how that's going to play out, and I don't think anyone else does either. And what kind of concerns me a little bit is that we've got this law of unintended consequences, and when you play around with currencies and bond markets and asset values to the extent that's occurred over the last few years, you just don't know how it's all going to play out. But I rather fear that it's not going to play out too well. There is fear about numerous things, and that's another big driver of markets at the moment. And those fears relate to too much debt at a government level, at a corporate level, and at a private level. People are worried about whether central banks have run out of ammunition. Have they fired all their bullets? They got nothing else to fire that's going to have an impact. Banks at risk due to oil loans and excessive leverage, and also lack of liquidity in the system as well. And I've got a graphic coming up that just shows you how staggeringly far that global banks, some of the biggest banks in the world, have fallen in the start of this year. It's extraordinary. People are worried about China far more than back in 2009, 2011, 12, when China was the savior. Everyone was looking to China to get the world out of the pickle that it was in, and now everyone's worried about whether China's going to have a hard landing. People are concerned about commodity prices and deflation, and with very good reason. And we've got an almost 100% correlation at the moment between the oil price, junk bond prices, and stock indices, and they're just tracking along with each other almost precisely, and I can't ever remember seeing that before. So these are all the things that are driving markets currently. Nearly all the global indices are in bear markets, as I said at the start. 65% of New York Stock Exchange stocks are in strong downtrends, and investors have tended to move heavily towards defensive assets. They've moved into bonds, that's high quality bonds. They've moved into gold, and they've also moved into defensive stocks as well. We've seen, consumer staples and utilities sectors getting a fair bit of the money flow. Banks are definitely on the nose around the world. The banking sectors have lagged, and in America, amongst the 9 main sectors of the American stock market, the banks are in the last, say, 2 months. The banks are the 8th worst performer. There's only one sector that's done worse than the banks, and that's energy. So that kind of tells you where where people are thinking at the moment. And you cannot have a healthy economy and a healthy stock market if the banks are lagging as they are. Trends and technical considerations are just absolutely swamping fundamental merit and value. Now they still matter. Fundamental merit and value is not going away, but it's all about technical considerations at the moment. And this presents both a danger and an opportunity. The danger is if you get caught in the washing machine in the middle, when markets are just churning backwards and forwards in the, with the incredible volatility that they're doing, then, that can be scary, and it can be, pretty dangerous. But there's a way to deal with that. And if you know how to do that, it presents terrific opportunity, because the further and faster prices move, then the greater opportunity you have to profit in shorter time periods. It's as simple as that. And I guess the other part of it is that because of all this fear and nervousness, the world's best stocks have just become significantly cheaper while in many cases their businesses are going as well as ever. So, you know, we're getting the opportunity to buy great stocks at a better price. Okay, let's just have a quick look at the S&P index. We'll go to the chart in just a minute, but if you watch the weekend general market video that I do, then clearly that you would know that the S&P index has changed character over the last 6 months, and that change in character is eerily similar to what we saw in 2000 and in 2008. Some scary similarities. Now, I'm not saying we're going to get a rerun of 2008, but you can't ignore the possibility that that could occur. Now, in the shorter term, there's always sharp rallies in a bear market, and we've certainly seen some of those. So let me just take a quick look at the S&P index. So we'll look first of all on a monthly chart, and I'm sure that most of you have seen this, so I'm only going to spend just a few seconds on it. Here's the monthly chart. Clearly it's doing something now that it hasn't done for a while. You can see the blue moving average line, which is the 12-month moving average, has clearly rolled over. The price is now living beneath that moving average, whereas before it was above it. We've broken a long-term trend line from 2011. So, you know, there's been a clear change there. If you look at it on a daily basis, you can see that even more clearly. The red line is the 200-day moving average. It's clearly rolled over. The price is well below it, and we're in downtrend. But in the short term, we're within this churning washing machine that really could go either way in the very short term. And just before we went live, I noticed there was a big spike in the German stock futures and therefore the American stock futures. I'm not quite sure what drove that, but you know, clearly something's been announced, probably in Europe, that's caused the stock market to jump up. But look, by the time I finish this webinar, they could have all reversed itself. That's just the way things are moving at the moment. Let me just pan back very quickly and look at this period back in 2008, just to illustrate a point that I think is extremely valuable. So here we are in early January in 2008. So we're at this level here around 1400. We got a lot of volatility throughout January and February and a bit into March, but we still managed to rally. And by May, the middle of May, we were slightly higher than we were at the start of January. And then we absolutely fell over into the GFC, the main part of the stock market crash. So whilst we're in a bear market at the moment, we're in a bit of a short-term uptrend. That short-term uptrend could persist for a few more months and still end up badly. And I'm not saying whether it will or it won't, but I'm just pointing out that you've just really got to step back from the day-to-day action a little bit to to get a sense of what's going on. All right, now look, I'll just stop there and I'll just deal with a couple of questions. Got a question here. Will the lead up to the US presidential election have any influence on the market? I can't get my head around President Trump. And Philip, you are not alone. I think half the planet is pretty scared about a President Trump. Look, typically on a very big picture level, the presidential election year is often not that bad. But having said that, 2008 was and 2000 was. So I think these days I wouldn't be leaning on any kind of old relationships, because I think central banks have distorted markets so much that a lot of the old relationships are breaking down and are fairly meaningless. So I don't know whether it will or it won't. We've got a bit of a lame duck president now. We've got a lame duck Congress where nothing much is going to happen. I don't see a strong relationship between what happens in the market and the presidential election. I think the drivers that I went through at the start are far more important. It's a lot more about China. Whether they devalue their currency. It's a lot about the price of oil. If the price of oil stays down, then I think that's going to be very bad for markets. They're the main drivers from my perspective. The next question from Graham, with the current global influence on markets by automated computer trading, is this likely to change the whole long-term psychology of the market compared to the last 50 years or so? I don't know about long-term because, Graham, because regulators may eventually step in one day and stop this stupidity of computer algorithmic trading. But I've read that represents something like 70% of world's stock market activity, and with highly leveraged hedge funds in control. I think for the foreseeable future, I don't know about for the long term, but for the foreseeable future, then I think we're stuck with these automated computer trading systems, causing this short-term volatility. But the good news out of that is that as long as you're not trying to play that same game with them, if you're trying to be a day trader against computer algorithms, you're going to get chopped up, absolutely chopped to pieces. So don't play that game. But if you step back, the good news about all this computer algorithmic trading is that it's programmed on pretty clear-cut fundamental grounds. Markets are bouncing around on support and resistance levels being where you'd kind of expect them to be, and Fibonacci retracement levels seem to be getting observed quite closely. If you take one step back from the day-to-day activity, I'm actually finding technically markets are pretty predictable. They're doing broadly what I'd expect them to do. So I'm finding it's quite a good thing. But it will require most people to amend the way that they approach the market. Okay. All right. Let's cover the questions for the minute. Let's move on. Global banks. Look, this is just a small snapshot, but the first 6 weeks of this year were dramatically bad and far worse than 2008. Now, I don't know whether that's meaningful or not for the rest of the year, but I don't think it's something we can ignore. And there's something bigger going on, I think, than just fear about oil loans. And it probably relates to this whole question about the world seems to be sliding into deflation everywhere, and central banks don't seem to be capable of doing anything about it. So here's the graphic that I mentioned before. The dark blue line, the dark blue bar is the first 6 weeks of this year. The lighter blue bar is the first 6 weeks of 2008. And you can see some of the world's biggest banks there. Credit Suisse is down 43%. Deutsche Bank is down 39% in the first 6 weeks, which was more than double what it was in 2008. And Deutsche Bank is something like 50 or 60% off its peak. The French bank, Barclays, UBS, the Swiss bank, et cetera, down the line. They're just extraordinary moves in some of the world's biggest banking institutions. There's got to be some nasty stuff happening underneath to get that sort of outcome. So look, we'll see how it plays out, but it's not a great sign. So what does this mean for investors? As I said just a few minutes ago, there's clearly a need for you to change your approach and change it considerably. If you want to try and trade and invest like you've always done, then the overwhelming probability is you're going to lose money or you're going to do badly, because the rules of the game have changed, and you've got to adapt with it. The other aspect too is, apart from algorithmic trading, is that there is so much disruptive technology coming in now so quickly that we can't assume that a business model that's been good for the last 2 or 3 decades is going to continue to be good and retain their business edge or their business moat in coming years. I don't think anyone can make that assumption. So, I believe investing for the very long term. I don't believe for the retail person, I don't believe is something you should do, because you could end up with owning businesses which are great now but obsolete in 10 years' time. It's okay for Warren Buffett to do that because he tends to control the companies, but we don't. Value matters longer term, but prices can reach irrationality before it gets there. And one of the things that I've found in talking to hundreds, if not thousands of people over the years, is that you can adopt the attitude, look, if I buy a great company and it goes down, I'll just sit on it and close my eyes for 5 years until it recovers. That's easier said than done. And a lot of people go in with that honest intention, but when the prices start to get sold down very heavily and you're down 30, 40, 50% on your investment, the majority of people get cold feet and they sell out. So they don't actually see it through. So, theoretically, yes, you can just sit on a stock and wait for it to rebound, but practically most people can't do it because their psychology just gets in the way and prevents them from doing it. So that's why I think investors have just got to be more active these days. It's just one of the consequences of the markets that we now deal in. I expect to see volatility continue to rise and be sustained at a high level. I say that because central banks have distorted so many financial systems to such a degree. It's like stretching the proverbial rubber band, and I just can't see any other outcome other than continued high volatility. I really can't. Now that makes decision making far more challenging, and it's where investors really need some additional support tools, whether that's information, whether it's a sounding board, whatever it is. But it's pretty tough to be an independent operator in markets these days. I think also too, practically, most investors should consider either hedging or short selling of some sort, just to try and dampen down the volatility in the value of your account. If you want to be long, fine on certain investments, but I'm pretty convinced that we're going to see some erratic moves in the markets in both directions. That's typical of bear markets. And, if you don't hedge that out, it can be pretty scary. Well, let's look at how you can lower your risk yet still achieve good returns. Okay, these are the steps that you can take. You can raise your cash level. Cash in a bear market, cash is a hedge. It's a great opportunity. So don't underestimate the power of holding cash in a bear market. You can implement some appropriate hedging, and I'll talk a little bit later about some of those different hedging techniques that you can use. You can buy great stocks when they're oversold during a panic. So that requires you to do a couple of things in advance, because if you're caught up in a substantial market panic and you haven't done your homework in advance, it's too late to do it. It really is. You need to be ready and raring to go before you go into that panic. So you need to know what stocks are going to come out of that panic very quickly, the ones that are going to rebound the soonest and the quickest. And you also need to have a sense of what price is likely to offer both fundamental and technical sense. Know that in advance. You might even have a few lowball offers in the market, and members will know that we've had a couple of them this week, that stocks that have dipped sharply and then rebounded very sharply. So there's always opportunities to do those sort of things, but you've got to be prepared in advance. Judiciously use some short selling if that's something that you know how to do. Short selling is harder to make money than in a bull market, but it's still possible. And there is another avenue that you can use rather than the traditional short selling, and that is to use inverse ETFs. And there's a lot of opportunity to do that in America. So you can use that to profit from the downside, and I'll come back and talk about what an inverse ETF is shortly. The next thing that you've got to do, and again I talked about this at the start, is you've got to know what the main trends are, and you've got to stay in step with them. I spend a huge amount of time chewing information from all over the world, from all different sources, so that I can get a sense of where the major unfolding trends are, and it's really important to understand where that's happening, and to understand what the changes are, and if, as much as possible, work from the extremes of oversold and overbought, or if you've got a trading range, buy at the bottom of the trading range and take profit at the top of the trading range. There's several different ways to do it, but as much as possible, don't try and be getting in and out of stocks when it's in the middle of a range, because the price can go either way. Just be patient and try and work as much as possible from the extremes, and I think you'll find it'll be quite profitable for you. The next thing is to build steadily. Don't make any big bets. Don't make any huge moves. Just build steadily, and if you need to take a step back, then don't necessarily dump everything if you get caught on the wrong side of the market. Because remember 2008, the first 5 months of 2008, the market was all over the place, but in May it was higher than in January. So the people that panicked every time the market sold off in January, February and March in 2008, they missed the opportunity to get out of their positions at a far better price. And this is where having the support of someone that's been through these cycles before is just so incredibly important. If you can email someone or ring someone up and just have a chat to them about how things are sitting, it could save you or make you a great deal of money. The next thing is gold appears to be poised for a major rebound. I've been, as anyone that's been listening to my weekend videos for a long time would know, I've been holding off on gold entering a new bull market, because we've had so many false starts over the last 3 or 4 years that it would have been extremely costly. But about 2 or 3 weeks ago, I really started to warm to the prospect of gold, and all the action that I see since then it just continues to raise my optimism that we're close to a new bull market in gold stocks. We're not quite there yet, but you could be positioning yourself now for that. I would also consider using ETFs, exchange traded funds, in some instances, particularly in America. We have some ETFs in Australia, but America's where we've got an absolute smorgasbord of ETFs on different sectors. And what using an ETF does, which is a basket of stocks, it avoids the very large moves that can occur if you own an individual stock. And all around the world this year, and again it comes back to algorithmic trading and hedge funds, if a stock comes out with a negative announcement, you can see price moves of 15-20% almost in an instant. We saw just a short while ago, we saw shares in LinkedIn drop 44% in one session. Now, they're probably massively overvalued, but 44% in a session, I mean, give me a break. That's just ridiculous. So both in Australia and America, we've seen these massive price moves that can be incredibly unsettling. And if you use ETFs, then that's one way to get around some of those massive moves that we've seen. All right, look, I'll just take another short break and I'll just address a few more questions. So let me just get back to where we were before. There's a question, am I in gold stocks yet? The answer is yes, I am. And so are members. The next question is about, what about the pullback for gold? Yeah, look, ideally, you do want to pull back for gold. So let's have a look at the chart. We'll go to, first of all, the the gold chart on a daily basis. So this is US dollar gold. So we've certainly started breaking some resistances. We've broken this downtrending line. We've formed a new high. So we've certainly got some preliminary. We've gone up. We've broken resistance. We've come back and retested, and we've looked like we're starting to go again. But there's many more levels yet of resistance that we would have to get through. But you don't want to wait until gold's up around $1,400 or $1,500 an ounce, because the gold stocks would have well and truly moved. So let's look at the GDX index. Now you can see GDX has been plummeting for some time. It got to a peak of $65 back in 2011, and you can see that it's still in a downsloping channel. Now it's working its way towards the top of that channel, and you can see that the price is now quite clearly above the red moving average line, the 150-day moving average line. And if you look at the on-balance volume down the bottom here, we've got a substantial rotation of money is going into the gold stock index. So there's no question that this is a lot more promising than anything else that we've seen over the last couple of years. So ideally, we'd like a pullback in gold stocks. Have we had it? Was this it on the 16th of February? We got a breakout above resistance. So that would have been resistance there at $17 on GDX. It pulled back on one session and then started going again. Is that it? I don't know. But this is a very, very positive move. Very positive move. And look, there's ways to position yourself. It's not necessarily an all or nothing bet. You don't have to go all in at this stage. The next question is it possible to short sell US stocks as an Australian resident? Short selling US stocks in the traditional short selling way, Jack, is I don't know how to do that in America, and it's quite possible you can do it, but I'm not sure of the actual practicalities of it. But I short sell in the US either by buying puts on my US trading platform, or using inverse ETFs, so buying inverse ETFs, or alternatively, I use my Australian CFD account and I directly short sell through that mechanism as well. So I've got three mechanisms that I can use to effectively short sell US stocks. Okay, next question is, how large an effect do you think oil junk bonds deteriorating and ensuing capacity could have on markets? Oh, huge. The impact is substantial. And what's really concerning me at the moment is the length of time that this bear market or this plunge in the oil price has continued for. In 2008, the oil price plunged over a period of about 9 months, and then it started rebounding very quickly. That meant that companies could survive. They could find a way to get through. This time, the oil price has been down for longer, and it's deeper, and it's not showing any signs of turning around. That means that companies aren't going to be able to survive. They're going to run out of cash. The junk bond market that companies in the oil sector and in other sectors were using to fund their operations, that's drying up. They can't get the credit flow that they were before, and they're having to pay substantially higher rates of interest even if people were prepared to buy their bonds. So yeah, the effect is huge. And that's really, I think, one of the triggers. If the oil price doesn't turn around soon, and I just can't see how it will, given the supply and demand, then it's going to trigger a lot of things. And it's not just oil stocks. I've read a lot of stuff that said, oh look, banks will be okay because only 2% of their loans are to the oil industry. Well, that might be true, But what about all the impact of all the associated industries that rely on the oil industry? You know, transportation. There's a whole bunch of American cities that are in population decline because the fracking industry is dried up substantially. So the impacts are potentially substantial. Next question: is there a reason why the currency is all over the shop to try and create a one world currency? Not important now, but in the long run, could it be possible? I'm not a currency expert, Clinton, so I probably don't feel qualified to answer that question, other than I don't think anyone is in control of the bus at the moment. And we've got a bit of a race to the bottom in currencies, and I don't reckon anyone can anticipate where this is all sort of heading. Okay, let's go back to the presentation. So looking at profiting when the market falls, I've sort of alluded to this. Short selling is an option, but for a lot of people, they don't understand short selling. It's a bit of a blue voodoo black art. So a more straightforward and effective way, if you've got an American account, and I'd strongly suggest that most people should think about diversifying outside of Australia, is that you just do it through inverse ETFs. And I've done a lot of work on these, and we're in the memberships, we're using inverse ETFs for both hedging and straight out directional trades. Huge amount of opportunity and flexibility in America doing it that way. So as I explained before, an ETF is just a basket of stocks. It might be 20, 30, 100 stocks. It varies all over the place. And an inverse ETF is just structured using derivatives so that it moves in the opposite direction to the index. So if you have an inverse ETF over let's say, the finance sector in America, if the finance sector drops by 5%, then the ETF, which you buy just like a stock, will go up by 5%. If it's just a straight vanilla inverse ETF, it's just as simple as that. So you're just basically moving in the opposite direction. The key is when to buy them. There's a smart way to do it and a less smart way to do it. And unless you've been tromping around in the market for a while, you probably won't readily hit on the best way to use them. Cash is a great position on the way down. I've been advocating now for probably 6 months that you should be holding an elevated level of cash, and that does two things for you. It means that you've got less exposure to the market and therefore less risk of downside. So you protect yourself both financially and psychologically. And secondly, if you've got cash at the bottom, then you can buy some bargains. If you don't have cash, well, you've just got to sit and watch the great bargains pass you by. So cash is a very, very valuable position on the way down. If you're a new person into the stock market, don't be in a hurry to get your money into the market. Cash is good. A possible timeline. Again, this is me just kind of trying to read the tea leaves at the moment in a pretty volatile market. But what makes sense to me, I just can't see the circumstances where the S&P is going to go back up and form a new high above 2100. I just can't see the fundamental or the technical environment where that could happen. Because part of the reason that markets got to the levels that they did was because of all the central bank stimulus and the fact that people believed that central bank stimulus would work. Well, people are now pretty much over that. The effect of central banks now is getting down to the negligible level in terms of its sugar hit on stock prices. So that's why I don't believe we're going to see a new high. I believe we form a lower high sometime between March and May. April is one of the strongest months of the year. not many people know that, but it is. It's quite a reliably strong month. So I wouldn't be surprised to see some volatility in March, a strong April, and then probably a peak in May lower than what we saw before. Now that's not me making a prediction, because I don't do that. I just kind of have a framework in my mind, but I retain a completely open mind, and I'll change it instantly if the evidence is there to support it. But that's what I reckon could be playing out at the moment. Again, one of the other reasons that I say that is that we've got a relatively low VIX index. To have a market bottom in place, the VIX index should have gone higher. It should have gone up around the 40 mark or more. It hasn't. It only just scrambled to 30, and then it's very quickly got back down under 20. So that's one reason that I don't think we've seen the lows yet. We've also had very poor market breadth. Now that's improved a bit in the last couple of weeks, but it's improving on rapidly decreasing volume. So to me, this is a dead cat bounce, and it's a pretty poor quality dead cat bounce. I don't think it's going to go too much further. What could cause a larger breakdown now? I think if China does decide to do a devaluation because of their capital flows out of China, then that would do it. That would really cause a lot of market dislocation. So I think that could cause a larger breakdown in the S&P below 1810. And if the S&P does break below 1810, then look out, there'll be a lot more, there'll be an absolute wave of technical selling hit the market. Another thing would be if fears continue to grow about the global banking system. If oil gets smacked again and gets down under 25, I think you'll see further deterioration in the world's global banking system, and that would be a real destabilizer as well. So related to the oil price. Just looking at where the world's great investments are, so thinking a little bit medium to longer term, where are the best growth prospects? So what I look for is sectors where they're reasonably independent of external events. And I've been saying this now for 3 or 4 years. It hasn't really changed. Healthcare and digital technology are the sectors, to me, that are going to continue to grow as a sector and grow significantly, because the things that are driving that, which is the aging demographics around the world and the amazing advances in digital technology and people's demand for all digital technology and connectivity offers, I don't think are going to change. So for me, those two sectors are going to continue to grow very well, independent of external events. However, can share prices get belted up in the middle of that? Absolutely. And we're seeing that with healthcare over the last 6 months. Healthcare has been, really has been hit unbelievably hard, unjustifiably so, in my view, based on fundamentals. But nevertheless, it is what it is, and healthcare stocks have been hit very hard. So that doesn't mean that just because the sectors are going to do well, that you just go in and buy them any old time. There's a way to get in, and there's a way to manage them. Now, look, I've added gold stocks here because I think there is some very good growth prospects. Now, gold stocks are definitely not a sector that are independent of external events. They're very dependent on external events. And gold stocks are definitely a fear trade. When people get really fearful, that's when gold stocks are going to shine. And that's where I think we're at now. I think people are fearful, and it could get worse. So they're not independent, but I think they do offer a good growth prospect. Let me just cover just before I go there, I'll just go back and check some questions again. So do we start to see the bottom in iron ore, zinc, copper, and nickel? Although a few Chinese economic indicators, GDP, PMI, are not showing any signs of economic recovery. Look, inevitably, commodity prices and commodity stocks will bottom out and start to move up before you see it in the GDP and the PMI numbers. There's no question, because markets are forward-looking beasts, so that will happen. But I don't see, looking at iron ore and base metals and oil, I just can't see on supply and demand that we are close to getting back into balance. Yeah, I just don't think it's going to happen. In the oil sector, the inventory build-up there, virtually every corner of the globe that can store oil is full. It's going to take between 1 and 2 years to break down that inventory, even when oil supply and demand gets back into balance. So I think we're not close, I don't believe, to the bottom in commodities, and therefore commodity stocks. Next question is, how do I distinguish between irrational selling versus deteriorating company fundamentals? Andy, that's a really good question. It's a huge question. I can't possibly do justice to it. I could spend an hour or 2 hours on that one alone. I don't even know where to start on that question, other than you've got to do a lot of homework. You've certainly got to know your fundamentals very well. You've got to know the sector well, and you've got to have a bit of confidence in the research that you're doing. And in the last couple of weeks, I've made a couple of calls. One on a stock that I said that had plunged quite suddenly, and I rechecked everything on it, and I said, no, look, it looks fine to me, can't see what the basis for it is. And it was pleasing to see that stock turned around very sharply today and was up about 10%, which I think kind of validates my assessment. But equally, there was another stock that fell that there was potentially some substance to it. So, for me, that was one where you probably would pull back. But yeah, that's probably the best answer I can give at this stage. Alrighty, just a little bit further to go to finish off. Thank you for all your questions. It's been good. So let me just cover what I've learned over the last 3 decades. Education is important. Yes, you need to understand things, but having experience through the cycles over and over again, and I've been through every one of them since 1987, is absolutely priceless experience, because it's how you control your emotions and having a bit of an understanding of how markets respond under different circumstances that makes it so much easier to negotiate the next one and the next one and the next one. And you learn very little from bull markets. Any old person can make money in a bull market. It's how you survive in a bear market that really determines your long-term success. And just having that experience of having gone through a number of bear markets is priceless in my view. Your first decision, most people that send me emails and ask me questions always start with, what do I think of stock XYZ? And I think that's naturally where most people's thinking starts. It's the wrong place to start. Your first decision has always got to be the big picture first, because you've got to understand the context in which that stock operates. First of all, at a global level, what's the sentiment like? How much exposure should you have? How much cash should you have? So that's the big picture determines that. And then we look at what the sectors are doing. What's the sentiment towards that sector? And then you work your way down to the stock level. So there's a heck of a lot of thinking and a lot of research that goes into it before you start addressing, what should you do? Should you buy or sell a particular stock? So that's really important. The next thing is never chase the price, and even more so in a bear market, just let the market come to you. And if it doesn't, then just go and find something else on your terms. It's not that hard. There's plenty of opportunity out there, particularly if you've diversified outside Australia. Know what you want to buy, know what price is attractive, and just wait until it clicks in. You won't have to wait that long. The next thing is to question mainstream thinking, because mainstream thinking is so often wrong. You know, one of the ones that always makes me smile is this slavish devotion to managing risk by diversifying. Well, that just guarantees a mediocre result. You can do so much better than that. There's also a level of thinking that holding cash is a wasted opportunity. In a bull market, I might agree with that, but in a bear market, holding cash is a fantastic opportunity. So question mainstream thinking. There's so many other aspects that I could highlight there. The next is media and newsletter writers. It's the best contrarian indicator in the world. So if the media reaches a crescendo of opinion, either positive or negative, then you know that you're very close to going the other way, or you should go the other way. A lot of people get scared out of good investments. Don't let that be you. Be very clear about what your game plan is, and try and do somewhat the opposite to what the market is doing. The world's your oyster. Australian stocks are about 2% of the global stock scene. There's just a smorgasbord of opportunities. I talked about all the even the ETF opportunities in America are just amazing. When it comes to investment priorities, capital protection is a priority. When I look at any investment or any trade, the first thought, it's automatic now and has been for a long time. The first thought is, how much can I lose? My first thought is not how much can I make. So capital protection is absolutely your priority. It comes before capital gain. And you just need to recognise that it has to happen in that order. Only buy the best quality stocks and the best value stocks around the world if you are going to go long. And that's pretty much the way you make money in the stock market. All right, just to wrap it up, for those that are interested in getting some support in whatever form that may be, and I can tell you if this is just such a valuable time to get support from someone that's that's been through it, that's got the scars, and that can offer you so much beyond just recommendations. So this is what I offer. There's a couple of different memberships where there's any amount of education, recommendations, and mentoring, covering both US and Australian stocks. One of the things that I've always tried to do in my business is to be available as much as possible as a sounding board. And I think that's one of the most valuable things that I can offer you. And I can tell you that if you talk to people that have been members with me for many, many years, as some have, that you'll end up receiving a lot more than you expect to receive. Now, the other side of things, so there's two options there in the education recommendations, one which is orientated towards investors, one that's orientated towards traders. Then the other half of my business is that I run a managed fund. If you don't want to do it yourself, then I've got an avenue that may interest you. The objective of that fund, which we started in the middle of 2014, was to consistently generate 20% per annum after all fees. That is not a guarantee, that is an objective. I believe that the methods that I use can allow that to happen. And in the first 12 months of operation, we did achieve that aim. So I was very, very pleased with that. So as I said, there's no guarantees around that objective, but it's certainly a very robust and repeatable process that I use, and you've pretty much got some insight into that process tonight. So to wrap it all up, there are various pathways that I can offer, either for people that want to do it themselves, or whether you would like to have some more direct assistance. That's really what I do. There's my contact details initially by email. Well, there's some more information there on the website if you haven't seen that. But look, whether you're interested in one of the do-it-yourself memberships or whether you're interested in the fund, I really do like to talk to people before they join either. So what I suggest, if you are interested, is just drop me an email on that address, and we'll set up a time to have a chat on the phone. And you can make the assessment yourself. I don't try and talk anyone into doing anything. I just make sure that people understand what it is that I do and how I can help them, and we take it from there. So that's the formal part of tonight. I'll just go back and see if there's any other questions. So I've got a question here from Tim. What's my opinion on small cap stocks? Is it just a gamble, or am I better off investing in larger stocks? Tim, look, my focus in Australia is on what I call niche stocks. Now, none of them would be really large cap stocks. None of them would be in the top 50 stocks, and hardly any of them would be in the top 100 stocks. They are great businesses. They are very focused on their niche. They're very good at it. They offer terrific growth. They offer very reliable growth. In many cases, they are attractively priced now. That wasn't necessarily the case a couple of years ago, but they are now. Almost everything that I do is in small to mid caps. I hardly touch the large caps. And one of the reasons being is that there's hardly any opportunity in large caps because they're so thoroughly covered by the broking fraternity that everyone pretty much knows what they're about. And so they're fully priced. It's hard to get an opportunity to get a decent run at them. Whereas some of the smaller to mid-cap stocks aren't as well covered. And if you do your homework, which I do, then you can uncover some real gems. And I can tell you, I've had some terrific successes just in the last couple of weeks when the market's been pretty nasty. So no, absolutely don't go back to the larger stocks. But I might add, unless you're very clear about what you're doing, and you're either doing your own research or if you're not doing your own research, you need to get your research from someone who's doing it thoroughly, whether that be me or somebody else. That's a given. Alrighty, let me just check through the question list here. I think I've pretty much covered all of these. Just scroll down. Yep, I think I've got them all. So that appears to be it. There's no more questions coming through. Thank you very much for your participation tonight. I really hope you got something valuable out of it. Just going back to where we started this whole thing, potentially there are a lot of dangers in this market. There's no question about it. But don't pull back to a point of perceived safety, because if your point of perceived safety is just owning some of the banks and some of the bigger stocks, then to me that's not safe at all. I think the safety is in the stock selection, it's in the process that you use, and it's in the discipline that you use in grabbing opportunities. That's where the safety is. It's in being more active. So that's my overwhelming take on things. I hope you enjoyed it, and I hope I get an opportunity to talk to quite a few of you over the next few days. That's it. Cheers.